Hello, Propenomix people, and welcome to another Sunday supplement. And this week's is about the Bank of England for the next 3 years and their report from the last monetary policy meeting earlier in May. I'm also going to comment on the macro stuff that's going on in the economy and also the real-time property market in the UK and what's going on. So if you've tuned in before, you'll know that I like to start these with a quote. And this week's is: forecasting our futures is built into our psyches because we will soon have to manage that future. We have no choice. No matter how often we fail, we can never stop trying. And that's from Alan Greenspan, the chairman of the Federal Reserve from 1987 to 2006. Just as an aside, that sort of 20-year period is something we could never really fathom these days. They tend to stay about a couple of terms in the US, maybe, 8 years or so, 10 years or so, and perhaps one term in the UK. I would have thought I'd be surprised if Governor Bailey carries on past 2028, but that's when his tenure is finished. So, and the quote really pertains as to how central bankers have to think, forecasting in the face of difficult and volatile times. And it's a good reminder that we're all forecasting if we're in the game of property investment and development. So before we go into this week full throttle, I just want to let you know Rod and I are running another workshop in July on Thursday the 3rd about joint ventures and mergers and acquisitions. And it's sure to be a highly popular one. Here's a whistle-stop tour of the agenda: market dynamics, JV opportunities, optimal legal structuring for property businesses, learning the pros and cons of limited companies, share classes, shareholder agreements, and sustainable JV models, diving into capital structuring, comparing debt to equity, managing risk, and understanding personal guarantees. Gain insight into property mergers and acquisitions from the due diligence stage all the way through to share purchases versus asset purchases. Applying the concepts through 2 in-depth case studies about acquiring an asset-backed property company and how to navigate a distressed business sale, understand strategic disposals, company wind-ups, and how to negotiate under pressure whilst you maximize value. We're still at the super early bird tickets phase because we've got more than 1 month to go till the event. They're online, but they're selling like hotcakes. So get in now at bit.ly/PBWSEVEN. And there is a link in the comments for that as well. So what did we see this week? Well, we saw Mr. Trump go all out for some peace brokering once again, business deals in the Gulf, free gold planes, and a little bit of rowing back on the China tariffs, which bolstered stock market confidence. What do we know even more than ever before? He sees business and deals as the way of solving all the world's problems. Sometimes he creates problems to solve them, which is strange, but perfectly possible when he doesn't necessarily understand the problem he's going to create before he starts. Then when it comes up, he sorts it out. So it sort of makes sense, but it's all a bit confusing, isn't it, really? It'll take many months before the markets start to trust him again when it comes to safe haven assets, and a poke in the eye on that front with a downgrade in the legendary US credit rating of AAA to AA1, implying a 0.04% chance of default compared to a 0% chance. Not massive, but the numbers are massive. Now, a couple of things on that downgrade. It's been made light of course it has, by the president, but in reality it puts them at the same credit rating as Austria and Finland, aside from anything else, which I'm sure they won't be too happy with. And a very good point that I read that was made by Ray Dalio on LinkedIn is that what tends to happen in credit rating downgrade situations, it's not the risk of default, which is still absolutely tiny, of course, but it's the need to print more money in order to sustain the bonds that people no longer want to buy because of the downgrade in the credit rating. So the market had already shown that it wasn't as keen on US assets as a safe haven play. That had already happened. And now that's playing out in the downgrade of the credit rating. So more inflation in the future is the thought of many of the sensible economic commentators in the US. So we'll forge onwards into the breach and talk about the real-time property market now. And credit, as always, to Mr. Christopher Watkins' efforts for the week. Here comes that question we simply have to know the answer to. What is currently happening in the UK property market? So this is after week 18 of 2025. Remember, we run a week behind, but it's as close to real time as you're going to get. And the listings data moved upwards a little less this week, as it was the week including the May bank holiday, or the first one in May anyway. 2025 is still the biggest start to the year for listings since 2015. 16.2% more listings than the 9-year average, 4.9% more than the equivalent year to date last year. and 10.6% ahead of the pre-pandemic market of 2017 to 19. My proxy data snippet here, the one thing you can remember from all of this is there's 10% more stock than normal on the market. So think about that. It's 10%. It's not a huge amount, but it's definitely enough to make a difference. There's 10% more out there than normal. And that's kind of holding up. That's close enough. I've been saying that for a few weeks now. So it was a short week, but we still had 34,900 new listings to the market in week 18. So that train in terms of listings is still very much forging forwards. And we're at a time of year now where you get more listings than sales agreed normally anyway, but we've already got so much stock on the market. So keep an eye. 13.5% of all stock was reduced in April. That's the rolling monthly average. And that compares to 2024's average, which still had more stock in it than we were used to, but less stock than this year, right? 2024's average was 12.1. The 5-year average is 10.6. So more stock means more reductions. That means in absolute number terms, but also in percentage terms. So we saw 23,000 price reductions around the country. That's last week alone. So lots of bargains out there, folks, or people willing to deal in order to sell their property. 23,400 went to sold subject to contract status, and that disparity or gap is still growing. 34,900 on, 23,400 sold subject to contract. There's a surplus there of about 11,500 homes. That's considerable. Now, of course, some of those do get removed or delisted. People give up the ghost. They can't sell it. They can't sell it at the price they want to sell it. They change their mind. Circumstances change, etc., etc. But it's very clear the amount of stock on the market is going up by thousands and thousands per week. As I said, typical for this sort of time of year. Clear outs happen in quiet periods and or at periods of change. So you'd look around end of August, New Year's Day is the biggest one, of course. And then fall throughs, they stayed below the average, the 7-year average of 24.2%. So again, think 1 in 4 fall through in a normal sort of market. It was 23.2% last week. So still high, of course. Very, very frustrating for people who deal with fall throughs. So we also look at net sales, which is the gross sales minus the fall throughs. They're still healthy, but they're only 6% ahead of 2024 year to date and 12% ahead of the pre-pandemic market. And we would have expected quite a bit of activity to have bunched into that first quarter because of the stamp duty. But we didn't see as big a schism as we've seen in the past when it came to the stamp duty. So perhaps not too problematic. But fall throughs are still slightly elevated, as we might expect. 5.51% in April compared to 5.36 in 2024. Not significant, and we need to see May's final figure, as the stamp duty would have washed out by then in terms of deals falling through. So again, this week, I won't read too much into the lower numbers because of it being a bank holiday week, but context is always key. My sense looking at this data closely week to week is that the market has slowed just a touch. There's still a healthy number of deals being done, but we're not currently heading to gigantic actual transaction volumes compared to 2024, in my view. So last year, to be clear, we had 1,101,860 UK property market transactions that were over £40,000. So in other words, the ones that filed a stamp duty return of some sort. That was an 8% increase year on year. And the first quarter of 2025 saw a 30% increase in the volume of transactions if we compare to pre-pandemic figures. That's 30%. But of course, some of that is because of stamp duty changes. How much was because of stamp duty changes? Well, a similar increase on last year. It certainly has a very good start. That would see us at 1.2 million transactions for the year, which is very much the normal sort of number for the UK market. So around 100,000 a month. It doesn't work like that because there are monthly fluctuations, of course, but 100,000 a month, 1.2 million for a year, a normal looking market. So I always give Chris a weekly shout out here, Chris Watkin, because he's much more prolific than just this epic tome he releases every week on the UK property market. He comes up with some great stats on a regular basis. So please go off, drop him a like, a subscribe, all the rest of it, and some kind words for his content creation. And if you're in the industry and want some support in growing your business, or to be a more effective communicator, be more in touch with your local market, that's his core business. So give him a shout. His article gets published weekly on the Property Industry Eye website, and the video goes on his YouTube channel at Christopher Watkin. Okay, stop. It's macro time. A rich week of data. We had the labour market and unemployment. We had growth. Then we have the first quarter's productivity flash estimate, which I'm watching closely these days. And then the gilts and the swaps. As you'll know, if you've watched before, I talk about them every week. I'm obsessed with them, to be honest. So the labour market. Expectations were landed, something that many of us have been anticipating for some time. Unemployment ticked up to 4.5%. Everybody expected it. But let's do a bit of context first. Unemployment hit 4.4 for a couple of months before the general election in 2024. That was April and May. It then dipped a little. It bottomed out at 4% in August, and then it rose back relatively sharply to get back to that 4.4, where it stayed between November last year and February 2025. To find 4.5% again, if we ignore the pandemic, we have to go back to June 2017. So this is a relative high in recent history. It's not a terrible number at all historically. In the old world, 6% was considered the event horizon or magic number, or a reasonable amount of unemployment, or certainly a recovery level of unemployment. So reporting here on March 2025, remember, because the government figures are a little bit behind. But if you very simplistically split the redundancies or the lack of hiring or replacing those who are retiring into those who acted preemptively, the businesses who acted first because they knew about the national insurance rise, they planned it all out, they forecasted it, they budgeted for it. And then you split into those who are reacting post-fact, so perhaps smaller businesses, perhaps hoping for a last-minute reprieve on national insurance. Perhaps they just don't do that forecasting and forward planning. Many, many small businesses don't. Then this number for March is going to capture everyone who's acted preemptively as far as the NI changes go, as much as they can do. Now, they might have to still consider lengths of service, redundancy, consultation periods, all sorts of things like that. Many big companies forecast at least a year in advance. So in October 2024, they wouldn't have been able to change their plans that much for March, April 2025. You'll see that more play out next year, perhaps. Let's see. Bit of speculation, of course. Then what about the ongoing impact, economic impact of it just being more expensive to employ anyone who gets paid over £5,000 a year, unless you're a tiny business? That has a small ongoing effect, of course, and that will persist. It's more expensive to employ people. So it's comparatively more expensive as well than any of the rest of your cost base. So we could argue, because the national insurance rise was a genuine shock, the impact thus far has been pretty minimal. But there's plenty of time to go before this played out yet. I think the actual numbers tell a bit of a different story, though. Number of employees on the payroll dropped by 47,000 between February and March, which is a significant number, and they're down 63,000 year on year. So there are fewer people on payrolls than there were 12 months ago. That's definitely bad, make no mistake. But the employment rate remains at 75%, and the economic activity rate or inactivity rate is down at 21.4. So who's economically inactive? We're talking about people between 16 and 65 who are, it's what they call the NEETs, not in education, employment or training, but they're not seeking a job. Sorry, they're not NEETs. They might be well be in education. It will count all the students, and it will count all the people who are long-term sick, aside from anything else. And it will count people who are in transitionary periods, just not seeking work at this time, either through no fault of their own or through volition. They don't want to seek work at this time. Perhaps, partners of people who have very high-paying jobs would be in that sector, of course, if they're in that age bracket. So the 75% employed is an increase on 12 months ago, and the 21.4 is a decrease on a year ago. So both those are positive things, right? Do we need to go back to the fact that unemployment has been significantly caused by bringing people back to economically active statuses? There's been a huge amount of fuss, furore, and press around disability benefits, for example, and the number of people accessing them, and the many more times of people accessing these benefits than have done historically in the past. I think it's close to 6 times as many people, when you look at the percentage, have been trying to access disability and sickness benefits. And of course, there's the pandemic to consider, but when you consider those figures in an international context, they do look ridiculously high. And this is why the government have had to act on that front, much as it's not very Labour and not very popular, certainly with their core voter base necessarily. So the point is, we brought people back from the sick list and potentially other parts, but from the sick list part of that economically inactive, and then therefore that some of them have got jobs, some of them haven't got jobs. Now, it isn't as simple as everyone who was employed a year ago is still employed, of course, so we do need to consider that. But I'm talking about the overall effect here. They become active, they can't get a job, so they go from the inactive bucket to the unemployed bucket in that situation, right? And this is why I prefer to look at the employed number of those three numbers, because there's still big problems with it. Don't get me wrong. If you're employed, it doesn't mean you're full-time employed. It doesn't mean you're working as many hours as you want to. However, we get into some of that in the Bank of England report. We've still got fewer people on payrolls. Does that mean people have been forced to go down the self-employment route? Because that's going to be a way of firms getting around national insurance. Of course, if national insurance goes up, there's a higher incentive for firms to avoid national insurance or evade national insurance. Some will be legal, some will not. The guidelines are there. Are people following them? I don't know. It certainly has meant in my businesses that I'm involved in, there's a much higher incentive to try and outsource or even use temporary or agency staff because of the incredibly significant, 11% plus increase, more than that if some of the staff are younger, in employing them. Whereas agency staff have not had to go up 11% as a general rule as part of this, especially if they're on the agency books as self-employed, as you can imagine. So you're by proxy using self-employed staff rather than using your own self-employed staff if you couldn't tick all of the boxes in terms of legality, aside from anything else. So 12 months ago, we were looking at 74.5% employed, 4.3 unemployed, 22.1 economically active. So both of those sets of numbers only add up to 99.9%, which is the frustrating thing about the ONS, but that's a rounding thing aside from anything else, right? So 0.7% have gone from inactive to active, 0.5% are classed as employed, and 0.2% are classed as unemployed. So that's about 70-30 ratio, right? As I say, it doesn't look exactly like that because not everybody else has stayed in their same buckets, but that's roughly what it looks like. And no, so we're not really in a worse state than March 2024, aside from anything else at this time. You'd also have to look at student numbers to consider how they've changed over that time period, of course, as well. So actually, it's a bit unclear on the unemployment front. I mean, the trend on the main headline number is in the wrong direction, but I'd say it's not as bad as many people thought. I think that's a reasonable conclusion at the moment. Now, that doesn't mean we've dealt with the NI shock. Remember, we're still talking about March's numbers. We've got to get through Q2 to really see what's going to happen. So I'm really keen on scrutinising these numbers closely over the next 3 months. The Bank of England themselves think that a 2-year window is reasonable to interpret the effects of the national insurance rises or to let it pass through the system because of the cycles that the bigger companies work on. I'm not in a better position to make a better estimate than them on how long it will take to filter through and where the spikes will be. It's pretty obvious that the spike will be immediately after the impact, so in awful April when we get those figures. But let's see how awful it was, because apart from anything else, we had drastically reduced inflation thanks to Mr. Trump's tariff meddling, but we have massively increased inflation thanks to national minimum wage hikes and people having to put prices up to cope with them. So it's going to be a really interesting number when that inflation number comes through. And it's not just never live by 1 month. It's always my mantra with these metrics. We have to take a considered view, which is why I've gone back and put a lot of context around those numbers this month. So what about vacancies? Well, 761,000 is the number. That was 898,000 a year ago. So down 137,000 on the year, down 42,000 on the quarter, and 34,000 vacancies lower than Q1 2020 before the pandemic started. So earnings are nominally up 5.5%, still unsustainable in this economy, comparing to 5.7 a year ago. This is why I'm puzzled when the Bank of England says this is softening. It doesn't seem to be softening fast. There are other ways of looking at it other than the ONS number, and they do show a slow downward trend. So I guess you could call that softening. It just seems very, very treacly to me, trickling downwards. 1.7% above CPIH, which is the inflation measure including housing costs. That's the inflation measure that compares better internationally to places like the US, who include housing costs in their inflation rate. It's a bit confusing, that differential between the UK and the US, but it is important. But 1.7% in real terms, therefore, is a positive for households, positive for real household disposable income. And that 1.7 was the same number 12 months ago as well. So there's been a little bit of going forward in household income in real terms, if you trust the inflation numbers. Labour, and I don't mean the political party, I mean the actual, the workers, they historically gain some edge on capital returns after a pandemic. So there's always this arm wrestle between labour and capital. The same appears to be playing out after this pandemic, which is not necessarily a bad thing if you think an element of income equality is helpful for society. And I'd certainly suggest that it is. So, bit of context. No one likes the number going up. But we do need to also bear in mind there's never been a Labour post-war administration that's left office with unemployment higher than when they went in. With unemployment lower than when they went into office. Every single Labour government has left with unemployment higher. Now, you could explain this away by simply saying, well, if they go in to increase the power of workers' rights, they make it more expensive to employ people, well, fewer people are going to get employed as a percentage. And I think there's some merit to that argument, right? And we also know the workers' rights side of things is coming in one form or another, but it's not been finalised yet. But this current wobble is much more easily explained by Labour simply making it disproportionately more expensive to employ people, and at the margin, in businesses that are already struggling, in businesses that are person heavy, right, in businesses where staffing is 50% plus of their cost base, is going to have an impact at the margin, right? There's no way around that. Basic economics, right? So what about growth? Well, another pleasant upside surprise, the third one in 4 months. And I'm in the surprised camp. I made the argument after the October budget that growth would be in the 1% sort of camp in 2025, more because of government spending, or G, as the macroeconomists call it, than increases in consumption or investment. Now, I don't monitor G on a regular basis, so I can't really comment on it, but I can say I've been pleased to be wrong about the growth rate. I should also say, though, we had quarter 3 2024 with PMIs that were printing around 53, but not getting much or anything in terms of growth, whereas we got 0.1, whereas we would have expected 0.3 to 0.4. So perhaps there's a little bit of rebalancing playing out here. And indeed, the Bank of England talk about this in some detail when they look at the difference between the headline growth rate, which is exactly what I'm describing now, and the underlying growth rate, which they're particularly bearish about, to be honest. So these were March's growth figures again, and quarter ones. And March had a 51.5 PMI, and we averaged about 51 over the quarter. So 0.1 would have been a pretty good estimate if these things were real-time accurate. But instead, we got 0.7. So a really significant departure. We had 0.2% for March. The Economist consensus was 0, whereas, as I say, the PMI would have thought maybe 0.1. And 0.7 for the quarter against an expectation of 0.6. But that quarterly expectation had been lifted significantly after we saw a very strong 0.5% monthly print in February. Now that sees real GDP up 1.3% on the year. So that's going from start of quarter 2 24 to the end of quarter 1 2025. Not bad, ahead of many expectations. Still pretty miserable, isn't it? 1.3 in an economy like the UK, but there we go. But in many ways, a much better surprise was business investment increasing by 5.9% for quarter 1 2025. The consensus there was 0.4. So that's a massive overshoot. But of course, you could say, well, this investment might be being driven by replacing workers with automation. But nonetheless, that would raise GDP if you put GDP above all else. So a fantastic Q1 result, while most have been moaning about the October budget. That definitely includes me, and being very concerned about growth after a whole raft of bearish business and consumer confidence figures. So does that mean everything's fine and it's all good for Q2? Sorry, I'm going to have to get the cold water out on that, folks. We're not going to keep this up. Quarter 2, according to NISA, the National Institute for Economic and Social Research, will be up 0.4%. Now, they've got a pretty reasonable model, but that looks too hopeful to me on the back of April's PMIs and the job report. I'm expecting private sector contraction, and I'm finding it difficult to model public sector expansion or contraction. The private sector is not GDP. It is the engine that pays the taxes to support the public sector and the engine that drives innovation forward, although there's plenty of public sector sponsored innovation as well, in fairness, through universities and the likes. But there's one point that I've made in the past, and it very much feels like it needs to be made again today. The NISA argument is one of slowing growth and headwinds, whereas mine's much more based on the genuine economic shock value of the national insurance increases. I've also seen an uptick in headlines on lost jobs in local government following the latest round of budgets for 25-26 fiscal year. And I'll wait to judge the PMIs. We aren't guaranteed a terrible number in May by any stretch. So will we get a massive rebound back to March's 52 plus, or will we be sticking around the 50 handle? That will speak to how much has been delay and moan rather than just don't spend because we need to keep the lights on or we can't afford to invest. Those are the two positions I suspect many businesses have been taking, but who's in what camp, I just don't know. So my thoughts are closer to 0% for the quarter rather than 0.4. So a big disagreement between me and NISA's model without significant volatility. But I feel we've got an awful April already in the bank. So that's done 1/3 of the work for Q2, let's face it. So I usually break down the figures so we can see the component parts of growth. Services grew 0.7 on the quarter. They're always the engine that drives this figure. Production was up 1.1 and manufacturing printed a 0, which is not a bad result given the sector how bad it's been after the announcement of the minimum wage rises on top of the national insurance shock. The best figure of the quarter, real GDP growing by 0.5% because it fell by 0.2 and 0.1 in the past two quarters. That's a great number, but again, a little more cold water, folks, sorry. GDP is discussed in real terms after inflation. We had some pretty low prints for our new world in quarter one, around about 2.8%. Q2 is not going to look that good. It's going to be a 3 handle on inflation, realistically, plus. And we need to see how the commodity price rebound goes and the tariff situation plays out, because that did have a big impact in April, folks. No two ways about it. Energy prices were up significantly in April, and we know we're expecting a 3% number next week for inflation. The current consensus is 3.3%. It may come in a little lower thanks to a particularly low oil price at the end of April. Brent was down about $13 a barrel, or 17.5% on the month, Brent crude. So is there likely to be a bigger inflation drag on the nominal numbers? Well, there will be in Q2 and Q3. That much is pretty much for sure. So in services, where were the winners and losers? Education and accommodation and food, perhaps unsurprisingly, given VAT on private school fees, for example, whereas the big winners were car repair. So are people repairing rather than replacing? Is that a sign of the economy at the moment? Information and communication and admin or support services. Construction at a 0 print again started to tumble on the PMIs with a terrible April number already in the can. 0.9% up on 12 months ago suggests a limping recovery. Again, I really can't wait for May's PMIs. Now, here's an alternative take contained within the ONS report that I don't normally highlight, but then it doesn't normally look like this. GDP growth was driven mainly by increases in the compensation of employees. This, in fact, is where all the nominal growth is coming from at this time, net, certainly in the fourth quarter of 2024. There's growth reported in self-employment and rental income. Neither of those will be a surprise, bear in mind what I said about employment earlier on, and the rental increases, which, of course, we followed very closely. Taxes also perked up thanks to higher VAT receipts. So not just private schools. General inflation will help with that as well, of course. Then real GDP is up 0.3% year on year. So something, but ultimately a miserable number. Real relief will be felt if and when this exceeds 1% in a single year, in my view. Our average number over the last 2 decades is 0.7% for context. That's increase in real GDP per head year on year. Labour have been keen to point out we're the fastest growing economy in the G7. The US, of course, shot themselves in the foot because of all these imports that they encouraged before Liberation Day in early April. But we're well ahead of the pack who are still limping, particularly France and Germany, who we would compare ourselves to in the most meaningful fashion. Okay, productivity then. It's nice to have a bit of room to look at it. We had the flash estimate for quarter 1 2025 and a revised overview for quarter 4 2024. Fantastic news, which might explain some, if not most, of the GDP growth. Productivity was 2.1% compared to 2019, and output per worker up 1.4% quarter on quarter. Now, the quarter-on-quarter figures ONS caution against using, because you do need more data than quarter-on-quarter. We're up on both measures, right? Per hour worked, 0.2, per worker, 0.4. So the output per worker was up 1.4 year on year, to be clear. Now, not a single quarter in 2024 did both of those move in a positive direction. So this is the best for at least a year. Productivity can, and indeed we suggest might well, go up when you force minimum wage up and the cost of employing people. Why? Well, because the more skilled and more highly paid are not the ones losing their jobs. The ones who are in businesses with lots of minimum wage workers who often have fewer skills and produce less per hour in terms of how productivity and output is measured. So get rid of a percentage of them and the overall numbers improve on productivity. Remember, economics is a bloodless game. Well, what went well when you look per sector? Construction and IT were at the top. Manufacturing pressed forward. What did badly? Real estate, ouch, and health and social care particularly. The health and social care productivity decay stands out as needing significant attention. Much of the rest didn't move too many needles. But great news in the short term. Zooming out a little, our productivity growth still looks very, very flat indeed. But let's see how we get on and see if the removal of NHS England, for example, provides the promised productivity boost too. We'll be keeping an eye on it. Now, our weekly delve into the gilts and the swaps. We ended last week on a bit of a drift upwards in the yields, if you recall. This week was no different. Friday especially trended upwards because the old logic is if growth is doing fine, no need to cut interest rates to boost the economy. And the growth figures were announced on Friday. Unemployment, it seems, was deemed already baked in. We opened the week at 4.08 on the 5-year yield and closed at 4.141. Thursday's close was 4.132. Now, Thursday's swap close, the last swap traded, was at 3.804. So a fairly considerable increase on the week, but then so's the 5-year gilt up considerably on the week, and therefore the differential remained at about 35 basis points, just under 34 last week. And that differential of 35 basis points discount for the swap has persisted for several months now, since about the turn of the year. So this puts the 5-year limited company mortgage rate with no fee at about 5.8. And those with eagle eyes would have seen some 5.7 and 5.8 products being released over the past couple of weeks. How about the broader market? What are residential buyers paying? Well, according to Money Supermarket, 3.8 is about the lowest for a 5-year with £1,000 fee, and Barclays and Lloyds are competing within 0.01% of each other. Those are at 60% loan to value or lower. Well, that looks cheap. That's on the swap rate, as we said, on Thursday swap rate. There's a clustering of products more around 4%, but still very close to the swap yield. Not unusual at all. Very competitive, the resi mortgage market. The swap yield's a good proxy for the resi homeowner rate. What they're hoping to do is get your banking and your credit cards and all the rest of it as well as your mortgage, one-stop shop stuff, right? Cross-selling opportunities. First-time buyers are paying more like 4.5% or so. Lloyds are leading that pack with 4.33. That's with a 10% deposit there. So we're still below that magic 4% number. Make no mistake, it's cheap compared to late 2022 and expensive but not ridiculous compared to a lot of the 2010s when rates were in the low 3s and in the 2s. But still 50% more interest each month is the other way of looking at it. So if you go from 2.5 to 3.75, your payment doesn't go up 50% because you're still repaying some capital as a homeowner. But as a landlord, it would if you were on an interest-only product, of course. So now into the deep dive. The week after the Bank of England meeting, I normally see the Bank of England local rep at the quarterly briefing, but unfortunately this month I couldn't make it. And so I've pressed on into dissecting the report myself at a level much deeper than last week's headlines. So buckle up, it's going to take a while, this, folks. He raised a smile when the bank rep sent me a LinkedIn message just to check in, which was nice. But I reassured him that just like Arnold, I'll be back. So I focused last week on the economic outlook and what's changed, which is a fair bit in the 3 months since the last Bank of England meeting accompanied by a full report. GDP expectations up considerably, but still vastly beneath what March's growth figures actually printed this week. And that means a hotter economy and fewer rate cuts if you take that on its own. Bank sees inflation about 3.4% for this quarter. Now, if oil stays low, that could easily be lower, but it's on the way back up, as already discussed. Unemployment of 4.6, so the 4.5 for March makes 4.6 for Q2, a pretty good stab by the bank, and some more excess supply or slack in the economy, as they colloquially say. because the demand isn't there for everything we can produce at the moment. You can blame confidence above everything else, I'd say, for that, quite frankly. The full report breaks down via a series of charts relevant parts of the Bank of England model and also gives some insight into their assumptions. The assumptions haven't necessarily come from the bank. Many times they use market information, but they use some assumptions to make up, to put into their models for inflation and things like that. So going forward, they're now expecting energy to have a deflationary effect on CPI in early 2026. So energy prices to be coming down from where they are today in early 2026 to move alongside our inflation rate. Now, these modelled contributions are smaller than any contributions to CPI even before the pandemic, and those were all upwards, let alone that hugely volatile time we had thanks to energy pricing in 2021 and beyond. So it stands out as looking hopeful or just plain incorrect. They're using a weak oil price assumption for the next few years based on prices that were depressed by tariff announcements in April. Similarly, their assumptions for gas prices are much lower than the report in February. They're just market snapshots, of course, but in the interim, we know that the US stock market has largely recovered. The US has, in case you missed it, lost its AAA credit rating and moved down to AA1 or equivalent with all those major credit agencies this week, as I said in the introduction. So that would suggest a weaker dollar, all else being equal, and also higher bond yields, right? And both of those things have been the upshot of the tariff announcements, although the bond yields have been more difficult to track, but we're right back up at relatively recent highs for the US 10-year, which is the proxy that generally gets used because it's the most liquid one the institutional investors want. They think in 10-year horizons, and they're buyers of that stuff. So the bank's model still had this sort of fantasy world where government expenditure growth tails off from 2026 onwards. That's because that's what's been put in the budgets. It was first of all borrowed from that future by Jeremy Hunt, and Rachel Reeves has continued to pretend that's going to happen. The likelihood is instead that austerity, as it would be deemed, or at least much lower or freeze at least in government spending overall. And when you think about the fact that defence has to move upwards as a percentage of the pie, everything else has to give a little, and the NHS never gives aside from anything else because it's protected. It does imply austerity in a number of other departments, right? Will that happen? We've just got to wait till October. I mean, there's the spending review in June to consider as well, of course, but wait till October and we'll see. I suspect that can will just be kicked further and further down the road because that's what we've seen overall over time. And then GDP growth is forecast to get just under 2% by end 27, early 2028. Sure, it's possible, but it takes a more reasonable interest rate and nothing to go wrong. And let's face it, a quarter without a significant event feels a big ask these days. So similarly, unemployment is going to be a little bit low fours, mid fives. You know, it's quite a big range that the bank's using there. By the time we get to the end of 2027, that's a pretty good range given how far out we are. But the midpoint of that range is about 4.8, which doesn't look too far wrong as I see it at the moment. The inflation forecast still keeps up the sham of us getting back to 2% in mid or late 2026 and puts us in the 2% most likely range from early 2026 onwards, with core inflation still where it is, north of 3%, and inflation likely to be 3.75 in September, according to the bank's own predictions. And notoriously, recently, they've been quite poor at getting it right when it comes to how transitory has inflation been. How long will it take? And what I can't put together in my mind is if the bank are sure that this sort of 2-year period goes on of companies adjusting to the number of staff they have and the minimum wage increases and national insurance hikes and all the rest of it, if that's going to take 2 years to play out, then won't the inflation involved in that take 2 years to play out, or at least similar, rather than be out the way by early mid 2026? It just doesn't seem to add up, does it necessarily? They're suggesting it'll be October 26 / March 27 before we've seen the full impact. The market has truly absorbed the full impact of this national insurance shock. So wouldn't be surprised if some price rises had to be held off for next year. Certainly what we've had to do in our own businesses is eat some this year, knowing we're going to have to try and get a little bit back next year when we see what minimum wage rises and what everything else that we're dealing with at this time. So I'm just not sure about how all that adds up, to be honest with you, but we'll find out. And I'm sure the bank have got, they've got far more many intelligent people employed than just little old me sitting in a spare bedroom, right? So let's bear that in mind. Now, if September, and there's no if about this, September is the month whereby we will define the index-linked, inflation-linked increases for 2026 in benefits, including pensions and the likes, right? Where the triple lock will be considered. And at the moment, the triple lock is still looking at 5.5% nominal pay rises, aside from anything else. So I don't see how all of that, whether it sits between 3.75, which is what the bank think, and 5.5% or 3.75 on the other index-linked benefits, how does that all work then, with inflation coming back to 2%? Still just doesn't add up to me. We lose steam somewhere, somehow. Maybe there's an economic slowdown induced by these tariffs and whatever's going to carry on going on in that department. But missteps on that front continuing by Mr. Trump might actually get the UK economy going, because it might be a better destination for capital than the US and some of the other anemic economies inside the EU. Of course, it depends on all these trade deals and how trade dealy they actually are, rather than mostly lip service with fairly small impacts on the economy within sort of 15-year timeframes that we're talking about. So there are some more minor metrics in the report that are worth a comment as well. The entire forecast sees a world where UK-weighted world GDP growth looks worse for us than it did 3 months ago. So this is the world's growth, but relevant to the UK because of who we trade with, aside from anything else, right? It has the US growing far more slowly than previous forecasts, but really it's therefore got everybody slowing down, which is what we would expect if there's a bit of a tariff quake, if you like. The bank's now raised its forecast for this year from 0.75 to 1% growth. And you would say, well, look, we've had 0.7% for Q1. We have, but the bank's still not convinced there's any underlying growth at all. So let's see. But you can't really stick at 0.75 when you've had 0.7 in Q1 necessarily, can you? But let's see if we get a negative print for Q2 or a 0, or whether NISA are correct and I'm wrong and they're still in the 0.4 bracket. Business investment also revised downwards, but we've had an excellent print for Q1 again. So again, maybe that's too bearish. Housing investment set at 0% growth, but resi is the only area that's holding up the construction PMIs at the moment. And this is a bit easier to predict, though, in terms of what will happen in 2025 because of the way the planning system works, aside from anything else. The savings ratio, the amount saved rather than spent, the bank has a higher level than ever before. So expecting it to average 10.5% now in 2025, presumably because of concerned customers, rather than fantastic returns to be garnered in savings account. And this meets the sort of story at the time in terms of the tariffs. And look, it is really difficult to take a report like this as a snapshot whilst a global relevant story has been unfolding, like the tariffs. So I don't envy the bank's forecasters. And it would be very mean-spirited if I just treat this whole report as gospel and pick holes in them. But my observation would be that savings have been roaring ahead because of uncertainty. But if you have calmer inflation and reasonable growth, as the forecast suggests, less savings would be a more reasonable expectation. There's a little bit more about savings later on. So the forecast is negative productivity growth. Q1 showing some signs of life there, as discussed already. The expectation is still a 1% growth in the working age population per year over the next 3 years. Now, if you think about this, it's a function of children already born who are going to get into that 16 to 64 bracket over the next 3 years. The people we know that are going to drop out on the other side of that fence. And then also, of course, migration. So Labour's recent white paper might suggest a tougher stance on legal migration numbers, but how will that play out and how quickly will it play out? We know that quick change is highly unlikely. But one assumption that still stands out, given the print is still around the 5.5% mark of earnings, is earnings at 3.75 for the year. This is going to have to dramatically drop to average 3.75 if Q1's number is 5.5. It's not impossible, but wages have looked very sticky, arguably catching up a bit with inflation, depending on which sorts of inflation you consider, housing costs, for example. So I do see this as a bit unlikely or overly hopeful. It won't surprise you to know the bank had a go at an alternative scenario where trade policy uncertainty increased significantly. They use an uncertainty index, which is an index of indices, 9 put together, and only one of these covers trade uncertainty, and that contributed to about 40% of the overall level of uncertainty, which is bringing overall uncertainty back to early 2023 levels. Now, it was receding at that point, recovering from the energy price shock and, of course, the budget of September 2022. Trade policy uncertainty contributing to this much overall uncertainty is unprecedented this century, which feels about accurate. It's the most upended way world trade has been for a long time. And what are you really seeing if you boil it down to brass tacks? You're seeing Donald Trump create all these problems, and then therefore that driving countries to be doing trade negotiations. It's been seen between ourselves and India, between ourselves and the EU, for example, between ourselves and the US. This has all been driven by Mr. Trump getting this right into the Overton window. Does it mean the way he did it was clever or good? Not necessarily at all, but it has been effective, which is pretty typical Trump stuff, let's face it. So the other scenario, they examine what has been my base case for years now, persistent inflation. Inflation 0.4% more than their forecasts in each of the next 3 years. Doesn't look unreasonable at all to me. Little more demand in the economy, keeping it running a little bit warmer than the bank's base case here. Possible, and I think certainly sensible to explore. Next up, the bank looks at current economic conditions, and one of the things that regularly drives me mad is them not taking into account what's already happened. This was particularly true last year, where growth projections stayed so low throughout, but then they ended up getting quite lucky because the second half of 24 was zeroed by the election and then the 2024 budget. Neither of those were predicted by the bank, nor were they mentioned, and I don't doubt that if the election had been delayed to December or even January 25, as many thought it would be, then the forecast would have been terribly wrong. But they were right for the wrong reasons, or close enough anyway. Well, let's look at the current crop, because what we don't have in terms of uncertainty is an election coming particularly soon. At the moment, you can't see too much other than the Labour Party clinging on by their fingernails, hoping that reform lose some momentum other than anything else. Now, it's an interesting distinction here because the bank talk about this underlying growth versus headline growth. And underlying is much more stable. And I used it as this week's image. If you fish this out from my LinkedIn or from Property and Poppadom's website or from the Partners in Property website. So in the February report, bank thought that underlying GDP growth was about 0.1% per quarter, leading up to April's NI hike. They've revised this down now to 0% for quarter one and for quarter two. That headline number, they moved their projection from 0.1 to 0.6. And of course, it actually ended up being 0.7, but that was released after the report. But it was a huge revision because they'd already had February's report, and February's report was well into Q1, of course. But on the back of it, they moved their Q2 headline number prediction to 0.1 from 0.3. So they're saying, look, headlines-wise, a lot more is fitted into the first quarter than we thought. Therefore, the second quarter will suffer. So you've got me at kind of 0, you've got NISA at 0.4, and you've got the Bank of England at 0.1 at the moment. And the bank's underlying no confidence in the economy can't really be ignored in the now. Now, hopefully, they're a little bit more bullish after the NI shock has dissipated a bit as we go into Q3 and beyond. But realistically, we know what we know. That shock will have cost us 1 to 1.5% in GDP growth, one way or another, and therefore being basically counterproductive, really. That sort of number costs the UK economy every year 8 to 12 billion. So if you're raising an extra 15, 16 billion net by the NI increase, you really end up net only about 4 billion better off. Doesn't fill any black holes, in my opinion. Just cooks the books, really. But that's the world that we live in. That's the Office for Budgetary Responsibility. If you don't like the Quango approach, I don't blame you, although I do believe that the Independent Bank of England operates an awful lot better than when the elected officials were setting the interest rates, because they just did a terrible job, especially in crisis times. But that's an aside. So it's not the only time the headline and the underlying have been significantly divorced. You can see why they kept their 1% prediction for 2024's growth, which was too low. Right, so perhaps they are overall too bearish on growth at the bank. I don't know. Something for all forecasters to think about here, including me. Underlying versus headline. So next up, they address stocks, currency and yields. They say equity prices fell sharply in response to tariffs. Well, they did, although the recovery by the time of the report was pretty clear. everywhere other than the US, which has continued to recover since then. Dollar depreciates to pre-US election level. True. Largely unchanged in the last month. DXY, or the Dixie, as it's colloquially called, that's the US dollar index, which pitches the dollar against a basket of other world large currencies, was bottoming at 98 in late April and now sits about 101, averaging around 100 historically, or 100 being the baseline historically anyway. It was 104 before the election. It was 110 at New Year's Day 2025. So the bank also notes 10-year yields haven't moved much overall since November. They've moved a fair bit, but they're back where they were. And then this sort of stable instability on yields is something I've noted over the past 18 months, since we found the top in the UK anyway, in June 2023, in everything other than longer dated bonds, who have since then found a number of higher highs in terms of yield. The expectation for the US bank rate has come down significantly since February, and the UK has absolutely followed it downwards. The only real comparative change is that the market now sees the bottom in the US rate as between 1/4 point lower than the UK rate, very low threes in late 2026. Explaining the market is never easy, but I would imagine the impending departure, due to the end of his term, of Federal Reserve Chairman Powell, and the surely guaranteed appointment of a significant Trump sympathiser who needs to cut rates above all else, has, after Mr. Trump's sizable hints in this direction, impacted market participants who believe the cuts will come, but then the rate will have to come back up to a more longer-term rate of about 3.5, which is where the majority believe that the natural rate of interest lies. Now, the Donald isn't going to care about the natural rate, of course. He'd want that to wait until his term had played out, aside from anything else, because he'd want as much help from a lower interest rate as possible, which makes perfect sense as a relatively simplistic argument. There'll just be a price to pay in the future in terms of things like inflation. Energy price futures have fallen significantly, which is based on revised lower global demand, thanks to tariffs. Globally disinflationary, of course, compared to other predictions, so it has its upsides. Cheap energy, something we no longer do in the UK, is key for economic growth, as we know. UK-weighted GDP growth being revised downwards is damaging as far as our GDP contribution from our export partners around the world. So if we use that recent India trade deal to put some colour around that, much lower tariffs on Scotch whisky, which you might have heard about, open up that booming Indian middle-class segment, who are significant consumers of whisky, but mostly buy domestic at the moment because of tariffs and price differences. So if that middle-class sector grows more slowly as a sector, our GDP contribution from those exports also grows more slowly. And the change in reference rates has come back broadly as expected in recent months. So when interest rates have changed, that has filtered through into the market, is what the bank is saying. My observation remains that the path of the 75% LTV mortgage has been very slowly downward indeed, but the 5-year swap rate has been very stable over the past 18 months. What you do know is a significant drop from the pricing in both late 2022, the budget, and mid-2023, which was where those yield curves really found their top, at least in the mediums or the medium-term gilts. Now, they were over 6% in both of those instances, and they dropped down to mid-4s. The average drawdown rate, that is mid-4s, rather than the best price, as I discussed earlier, when we're thinking about household mortgages. 2-year mortgages since late 24 have actually been renewed at cheaper prices, and they've rolled off that, which won't be a surprise for anyone who got into a 2-year mortgage deal in late 22 or early 23. So that's actually making a negative contribution to the average price of the outstanding stock of debt, which is something that I watch on a monthly basis when the bank's money and credit report comes out. So that's in the supplements near the end of the month, at the end of the month, just after the end of the month. So next up, they address the surveys, which have been very bearish and form a large part of making their expectations for underlying growth being close to zero, which has been my own expectation, aside from that government spending element of growth as discussed. And there's a notable tick up in very high uncertainty amongst the bank's panel surveys, which asks all of their decision makers, which is a decent sized sample over a whole number of different sizes of businesses across the economy. The investment intention surveys are also very bearish, which we know because we monitor them on a weekly and monthly basis. And as I say, has it been delay, moan, get on with it in the end? Or has it been delay, put capital elsewhere, distribute capital to shareholders, use capital to keep the lights on rather than investing it? And there'll be some truth somewhere in the middle of those two positions, of course. And then the household savings ratio in quarter 4 2024 printed 12%. I didn't talk about that. I haven't talked about that before in the supplement. That set the bar for this year and beyond. But overall economic negativity strikes me as a fair bit lower today than it was at the turn of 25. It could be a significant change if we get to Q3 without the job market falling apart, which does look eminently possible. That 12 handle compares to Q1 2010, where all the talk was of double-digit recessions and inflation. If we ignore the pandemic, that sort of number hasn't reared its head since the mid-1990s. It can be seen as a bit of a barometer for consumer confidence in terms of real action rather than talk, if you like. The next number for Q1 will be out at the end of June, so as always, we'll see. But it would be rare for it to remain up there, but you can see why the bank has predicted 10.5% savings ratio this year. Now, this data is interrogated further by a survey. Why are households saving so much at this point compared to recent history? The savings ratio has been down in the half of this, the sort of 5 to 6% range in more stable times recently. So what's the big one? Well, much higher interest rates on savings than there have been for nearly 20 years. Now, that's been selected by 39% of people in the first half of 2024, now being selected by 27% of people. So that's obviously providing less of an incentive because the rates have come down, aside from anything else. Biggest contributor at the moment, rebuilding savings or not having enough for emergencies, 34%. Savings for major purchases, 25%-ish, that's pretty stable. Concerns over increasing housing costs is another category, alongside making up for the lost value of the house or falling investments. Now, I'd see that as actually people saving in order to make up for the fact that they need to try and pay a bit more off the mortgage because the mortgage payments are going up so much. So that's really the normalization of the interest rate category is how I would interpret those categories, really. And those add up to about 25% or so as well. Just because there's extra cash from a higher income or second job as well, that's another reason that's used in the mid-20s in terms of how many people selected it. Concerns over household members losing their jobs, actually lower than they were at the start of 2024. So the biggest takeaway is lower incentive to save due to savings rate having come back a little. But people are preparing for emergencies and they are clearly working second jobs or have had pay rises that are enabling them to save. So very high savings rate at the moment. What does it mean? It means that people don't spend. They aren't spending, they're saving. So they're not consuming. They're saving it instead. In economics, it's very simple. You either spend it or you save it. And if you spend it, it goes into the economy, it goes into the circular flow, it generates VAT, it generates tax, it generates economic activity. And generally speaking, it helps us if more people are spending more. So they then come to one of the softer conclusions I can imagine. Maybe it's fair, maybe I've been too bearish on the increase in the cost of employing people. Underlying employment growth is judged to have softened. Or if we're a bit more macro, if the underlying growth in the economy is currently zero, as the bank thinks, then employment growth would also, all else being equal, be zero. There are a couple of metrics the bank likes to watch here. V over U, or vacancies divided by unemployment. As I talked about vacancies earlier, the bank sees the equilibrium ratio at about 0.6. The current number is 0.5, so that means one vacancy for every 2 unemployed people, or 5 jobs for every 10, versus 6 jobs for every 10 being equilibrium. So not terrible, just about an employer's market, all else being equal. V over U was indeed 1 shortly after the pandemic, so there were 10 jobs for every 10 unemployed people. So that's basically halved, that V over U, since then. Or the number of vacancies has halved, pretty much, which has played out. They also watch net additional desired hours. So this is a good metric, right? How many more hours do people who are already working want to work? This was about 1.75% at its peak in the 2010s after the financial crisis. Today it sits around 0.7. In 2018 and 2019, it was around 0. And it was also 0 in the immediate aftermath of the pandemic. So there isn't necessarily a job for everyone, or a long enough or enough hours for everyone who wants more hours. Labour productivity has remained weak, and in spite of my revelations today, only just above 0 is exactly that. It's just above 0 in terms of productivity growth. The bank looks at pay growth, and as I say, they say slightly lower. Their graphs show sub 4% by the end of the year. That's what the decision makers panel think. That's what the agents' reported numbers are. The agents gather things from their local businesses. They see it as about 3.75. Perhaps that will be what plays out. They're normally pretty good. If that's what they think is going to happen, that's what they're going to go into pay negotiations doing. So we are going to see a strong drop-off in wage increases at some point over the next coming months. Let's keep a close eye on it. I think the difference between 3.75 by the end of the year and 3.75 over the course of the year, of course, will be different. And as I say, September's number will be a big one because of the triple lock, aside from anything else. So one of the classic dry statistical conclusions the bank makes follows here. Underlying wage growth is higher than expected based on its key determinants. So read into that what you will. It's unsustainable from a business perspective for wages to keep going up as they have been. I've said many times since the pandemic that historically, Labour wins the arm wrestle over capital in times following pandemics. But if it's an employer's market at the moment, when we look at V over U, is that logic going to hold up? There's a very large residual at the moment that can only come from the pockets of shareholders if they're willing, and they rarely are, let's face it, or from the magic money tree. Following that logic, a drop in wage rises may indeed sound more likely. It's just this ongoing stickiness of wages that strikes me. Also, how will the minimum wage benchmark be set for 2026? We find out about that in a few months' time from the Low Pay Commission. In terms of the breakdown of inflation, the bank now has a graphic for national insurance contributions, seeing it adding 0.1 to 0.2% per month to the change in CPI inflation, putting it higher, of course. Energy's baked in, however, because the cap's currently predicted to drop by 7% in July. I'm not sure the bank's forecast is valid anymore on the energy prices in the short term anyway. But this effect will be well highlighted in April's inflation number when we see it next week. The thoughts are around 3.3-ish, but it may well have come back a little bit thanks to these discounts caused by Tariffgate, other than anything else. The bank also expects services inflation to continue around 4.5% to 5% for the rest of the year, and food inflation to touch more like 4% again. Will the recently announced EU trade deal reflect on that? There are people saying, look, this is immediately going to mean we can put prices down on food, and the supermarkets being a little bit more cautious than that, but certainly suggesting that it could be disinflationary or indeed deflationary over short periods. We've got to wait and see how long it takes to play out. Pay growth is driving inflation more and more in manufacturing and retail, so the feared wage price spiral from a couple of years back is gathering momentum. The move is from between 15% and 25% of manufacturing price rises being ascribed to higher labour costs to 40% of those price rises being explained by higher labour costs. In retail, that was 15 to 20%, and now it's 30%. So it's forming much more of the inflation side of things, and it is adding a bit of fuel to that wage price spiral argument that could potentially still play out, although we've very largely been able to avoid it. Households have now got a baked-in inflation expectation of about 3.5% in both the short and medium terms. Historically, they've been at about 3%, which is pretty sensible because the average inflation rate in the 2010s was 2.7, regardless of what the target was. Now, in some polling, those numbers are more like 4% plus compared to 2.5% to 3%. So that looks much more pronounced, right? What's strange is that sort of expectation would normally see people spending more money now because prices are going upwards rather than saving and waiting for higher prices. But perhaps this is more inflation lag in that people cannot possibly not have seen it or ignored it by now, and now they've just sort of given up and said, oh, inflation is ridiculous. Let's just get on with it and accept it. It's probably 4% going forward. Or is it simply it's just been going on for so long, it's just going to keep going on and on? It's certainly more congruent with my 3% is the new 2% argument rather than the bank's hopeful 2% inflation orderly return argument, which I'm still rejecting for 2026 and 2027. Business inflation expectations centre much more around 3% for both 1 and 3 years ahead. They're just ahead of 3% for 1 year, they're just below 3% for 3 years. Then there's a final chapter on tariffs, which I'll summarise because apart from today, I haven't really talked about them extensively. More than half of UK firms expect lower sales to the US thanks to tariffs, and we already know about the uncertainty. Interestingly, around 20 to 25% of all firms who do no exports at all still expect lower sales in the next 12 months because of tariffs. But of course, there could be logic in that because if you know that you supply companies that do then export to the US, you're part of their supply chain, it still affects you indirectly it affects the demand for your products or your the people that you trade with or sell to. It affects their willingness and ability to pay, right? And then the bank ends by noting the increase in the money supply that I've highlighted in recent months and the repair in net lending to the private sector as well, now that interest rates have really normalised, or certainly have been seen to do that according to the market. The current rates at the household level in terms of what they call broad money growth are pretty much in line with most of the 2010s after a big squeeze between 2021 and 2024, which is characterised by blaming the cost of living crisis or explaining by looking at the cost of living crisis anyway. Whether one caused the other is more difficult to define. The numbers very clearly show a departure from the trend. The bank prefers to talk about the erosion of the money overhang from the pandemic, basically describing an overstimulated economy, rather than talk about the cost of living. But arguably, it's just two sides of the same coin. Now, there's also an annex, which I want to discuss briefly. I know we've been going on for a long time today, so if you've made it all the way through, well done. But these are my favourite outputs from the quarterly surveys, other forecasters' expectations, presented as versus the bank. So other forecasters have a range of predictions. For example, the predicted range for GDP growth in Q2 2026 is between, this will still be the annual rate, bear in mind, is between 0.4 and 1.8. That's a huge differential. The average is 1.1, and the Monetary Policy Committee's projection is about 1.4. So they're above the average. In Q2 2028, the MPC expects 1.9% growth, but you cannot find any other forecasters who think we could get to 1.9. So looks a bit hopeful aside from anything else. Now, I'd always trust the forecasters more than the MPC alone, simply because of what's called the weight of the cake argument. And this is the phenomenon that if you ask a large enough sample of people, 30 is usually enough, but let's say 100, to guess the weight of the cake at a school fair or a fete or similar, then the average will normally be very close to the actual weight of the cake. There's a wisdom in the crowd, if you like. With more strange or rare events going on, such as a pandemic, there's been much more reason to depart from this sort of logic in my book, where I've been above the inflation expectations of everyone in the bank forecaster's black book, and I've been much more accurate than they all have when it comes to inflation. But as we calm down, tariffs aside, the more sedate modelers and the average approach obviously has much more merit. But I still do my own numbers. My logic for stronger growth in 2027 and beyond would be because of the choke being applied at this time by uncertainty in the policies of this government. This will have a pent-up effect, which will release at some point. And you'd see this as part of the savings ratio coming down. That would be one way this would manifest itself, more investment, aside from anything else as well. But I am concerned about this lower government spending, not because we don't need to curb government spending, we absolutely do, but because by definition it also affects growth negatively. But as I said earlier on, I don't really believe this will happen. Reeves will find a way not to do this or not to do most of it by borrowing again from the future. She has this 5-year period over which she can say she'll make cuts, and people still believe her at the moment. They believe Jeremy Hunt, or they're sceptical, but they can't prove what hasn't happened yet, I guess, is another way of looking at it, right? So growth forecasts don't look outrageous, but I still feel under this administration, 1.5 is a really aspirational number rather than 2%. The bank also models unemployment to be higher than the other forecasters, hitting those 5% numbers. The ranges are 4 to 5.5 over the coming years, but the averages are closer to sort of 4.5, peaking in 26 as we've felt the full effect of the NI shock, and then down again as time goes on. And that 2-year period does make some sense, as I've discussed earlier. My feeling was still we'll hit 4.8 this year, and so I'd expect Q2 26 to look something like 4.6, although predicting between 0.1% is difficult and possibly, arguably not worthwhile. But what about inflation? Well, what stands out is a huge range of thoughts over the next 12 months, which then narrow significantly as time goes on. That doesn't make much logical sense when you think about it, because it's much easier to predict the next 12 months than 36 months' time, but it does speak to the uncertainty that tariffs have created, both in terms of first-order effects, are goods more expensive, well, they are for Americans, and second-order effects. Do other countries drop their price for their exports to other markets other than the US, such as the UK, in order to maintain their market share and volume of production? Also, they don't end up with a lot of slack in their economies. Do they subsidise things, etc., etc.? All of these things can happen when there's a bit more certainty over the 90-day period after the mid-April negotiations, other than anything else. So we smack bang that into the middle of the start of the summer holidays, apart from anything else. So don't take your eye off the ball. The forecasted range for inflation in 12 months' time is between 1.2 and 3.2. Now, that's a massive range, right? I'm close to the top end of that, but I've got a lot less certainty than I have had because there's so many things to impact it. Where does this tariff situation end? As our US trade deal really supposedly put this to bed, there's no limit as to what could happen if we start talking about tariffs on films, as Mr. Trump has already done, for example. It's never been done in the past. It's unprecedented stuff, right? The average forecaster says 2.1. The bank says 2.5 in quarter 2, 2026. They track much more closely together the further in the future we go, with the bank below the forecaster average, but the consensus is that we will be back to 2%. I just don't believe this anymore at this stage, particularly with credit ratings being cut and the likes. The markets are onto us. The real number's 3% these days. That bit I've got a lot of conviction in. And the household and business inflation expectations look a lot more sensible to me. So to round off, in 3 years' time, quarter 2, 2028, the forecasters see GDP growth at 1.4, unemployment at 4.5, and CPI to be 2.1. In order, I'd say, sensible, possible, but hopeful, and then way too hopeful. So I'm saying growth around 1.4, fair dart, 1.5%-ish. Unemployment 4.5, I think it will be higher. And CPI, I bet the farm on it being higher than 2.1 in 3 years' time, to be honest. But things will play out as they play out. Let's see. Thank you this week for indulging my macro obsessions as I got very, very deep into what the bank was saying in the quarterly report. I hope you found some use in it. I hope you found it interesting. And as I've come to the end, please remember to book your tickets if you haven't already for the Thursday, the 3rd of July, Property Business Workshop, Joint Ventures and Mergers and Acquisitions. It's guaranteed to be a fabulous day of learning and discussion. You can still get your super early bird tickets, genuine 20% plus discount, bit.ly/PBW7. And above all, please remember to keep calm. Always listen to the supplement, of course, and carry on. There will be opportunities abound this year and towards 2030 and beyond, I'm sure. These risks at this time, although they feel significant, the geopolitical and trade ones, are far less meaningful to the UK housing market than they have been for several years. Of that, I've got no doubt. Good luck and thanks for listening.